So I think we are live now. We should be live, and of course, we were live. We started the Real Fridays podcast about 4 minutes ago, and finally Brock had the wisdom to say, "I don't think we're live." So this is the kind of an abbreviated episode of Real Fridays. Brock's going to be traveling for some holiday stuff, and I know Jeremy's going to be late as usual. So and I have some things to do as well, but. This is good. There's been so much going on. I mean, it's crazy. The industry is being sort of turned upside down, which to some degree for technology and innovation, I think that's a good thing because pretty much all the industry forecasts of rates going down to 6.25, 6.3 don't really seem to be materializing to that. I mean, as of I haven't checked the 10-year yield today, but I know as of yesterday, we were right at. Oh, so it has gone down a little bit. So it's improved slightly at 4.48 or so. No, it's actually getting worse. Well, I guess a little bit.
Rates jumped a little yesterday, right?
Yeah, they jumped yesterday, and so they're still trending toward that 6.5% sort of target, which I know that. The problem with the industry right now in the last couple of years has been, especially since the Fed has ticked up rates to combat inflation and a number of other economic uncertainties, is lenders have been putting their hats on like, we're going to have a low rate environment soon. It's going to be soon. It's going to be soon. It's going to be this quarter. It'll be next quarter. It'll be the following quarter. And so they from a tech spend standpoint, they've sort of been charging forward, 2 steps forward, 3 steps backwards when it comes to their commitment to it. And we've sort of taken a 3 steps backwards, with rates going up yesterday. And despite the Fed dropping the Fed rate a quarter point, 25 basis points, the reality is there's just too much uncertainty in the marketplace, to really, and I did a post yesterday on this on LinkedIn to discuss a bit around how that's okay. I think rates will end up exactly where we expected them to be at 6.25 or so. But as of right now, the way it looks, it's going to be 6.5 plus. So what, as you have conversations, do rates really affect what you do at NewZip, or does it create urgency enough to say like, hey, rates are going up, that relationship with the loan officer and the realtor is ever more important, so we have to have a solution like NewZip to secure that relationship? Or
it's I mean, it definitely matters, but it matters in the sense of how it affects mortgage behavior. It doesn't matter. It doesn't affect NewZip's product in any way. Everything we do we're a real estate company and a tech company, really. And we're selling integrated real estate solutions. We're not per se like touching the mortgage transaction. So it doesn't technically matter, but practically it does matter a little bit because everything follows rates in this industry. But what's really interesting is when we see rates drop really dramatically, which hasn't happened a lot. It happened for a minute in March. It happened for a minute in like August or September, where rates, temporarily dropped a little bit. It's actually kind of negative for our business because everyone pivots all their attention to refi. So the best thing for NewZip is just kind of a healthy, stable market where people are trying to get better at purchase. And so for us, like, we'd love to see that, lower is great in terms of affordability. We have tons of first-time home buyers and tons of other people that are looking for deals, obviously, whether it's investment properties, vacation properties, whatever. So we certainly like seeing lower rates. But I think NewZip gets held in more focus and more in higher esteem almost when rates are a little bit higher, because we help the client save money, help with affordability, and help lenders with their purchase strategy, which, when rates are higher, it tends to be that you have to do purchase because there's much less refi to do. So it's kind of a not good nor bad relationship with rates for us, I guess. Good for lenders wanting to work with us when rates are kind of like stable, but not super low that it's a refi boom.
You know what's bad when we look at August and September as kind of the good old days? It's kind of like, we're gonna get there. All kinds of hope and optimism. Oh, we're gonna do, 2 trillion or more. We're gonna kill it next year. Q3 is looking good, and then we just hit this wall. And in my theory, ironically enough, the Vegas odds, on October 7th, had Trump winning the election.
Mm-hmm.
And I suspect that basically that's when the bond market in the 10-year ended up responding accordingly, almost pricing into the market the fact that there's going to be, all these threats of tariffs, a lot of uncertainty. Are we pulling out of Ukraine? Are we going to get into Syria? What's going to happen with the conflict in Russia? There's all these uncertainties. Like, Trump negotiates with uncertainty as a negotiating lever, which might be great for politics, might be great for negotiation. It's terrible for the markets. And so the reality is the market's responding to a Trump win back in early October, which is what created this uncertainty of saying, hey, we really need to sort of move treasuries really over to more sort of safer assets, because we don't really know what's going to happen with Canada being our next 51st state, right? Like even though a lot of that's rhetoric, Trump to kind of be Trump, but the reality is the markets don't like that. The markets are jittery. So when Trump talks about buying Greenland and annexing Canada, it's like people don't know, like, is this guy for real? Like, are we actually going to bomb North Korea, or what's happening here? And as a result, the market is going to be extremely volatile, and I think that's what we're seeing here.
Markets are always seeking certainty, right? And so him continuing to Trump, the guy, the overall, I guess even not even in office yet, right? So it's like even less certainty. As it's one thing when he's in the office and maybe blustering or whatever. Maybe he's last term, used that tactic pretty effectively at certain points. But it is terrible for certainty. It's terrible for pricing anything. The chance of trade wars or actual wars or anything, even if it's just a little tiny chance, is enough to throw this all haywire. So I read your post about that. Was that this morning, or I saw it this morning? Maybe it was last night.
I posted it last night because I think it's as I was kind of looking at the averages, it seemed pretty clear to me. And then I just said, well, I wonder when the Vegas odds started trending more toward Trump. Yeah. And it was right the first week of October. And it just coincided almost too coincidentally with the 10-year just starting to sort of climb. And that to me was just sort of the really the securities markets just responding in a way that said, hey, we're heading toward a Trump presidency, which is an interesting indicator. You have to wonder if the Harris campaign saw that sort of as well. But guys, you guys have haircuts. You guys are ready for the holidays. I can always tell when Jeremy has a haircut because he has an afro that would rival any 70s basketball player. But now when you're nice and you got like a kid and play high and tight, it's awesome. I love it.
That's how we roll, man. My man Justin in Detroit. Anytime you're in Detroit, we'll come get you a cut. Justin Dahl.
Dude, I love it. I was actually just making the comment, Jeremy, that the first week of October, Vegas odds of a Trump presidency started to sort of fall in favor of that campaign, right? And it just coincidentally, at that very same week, the 10-year yield really started to climb, and it really hasn't looked back ever since then, because even though Trump uses sort of unpredictability as a negotiating lever, it just becomes the markets don't like it, right? And so when talk of Canada being our 51st state and or bombing North Korea or Iran or all these sort of erratic things that are said, it becomes difficult to sort of like, where do the futures go around that? Like, how do you actually sort of organize and place investor related bets based on such unpredictability,
Yeah, agreed. I mean, I think there's a bunch of assumptions baked in. This is what makes the competitive free market, which is you have to make bets and you have to make assumptions. And I think how you make assumptions about what's real and not real with political bluster, political positioning makes all the difference. That makes and breaks companies. That's what CEOs' jobs are. That's what hedge funds managers' jobs are. Is like, how much do you believe? How much do you not believe, given the information you have right now?
So one comment I made, Jeremy, was, well, the headline this morning was everyone's forecast. Forget about what we saw last week in the mortgage origination forecasts for 2025 by Fannie, Freddie, by the MBA. Throw all that out the window. It's going to be sort of a worse year than had originally forecasted a week ago. And I actually think that's good for tech innovation because it's going to focus now all of a sudden. There's been another sort of takeaway, right, where the markets has said origination's coming. Let's start preparing for a really strong year of north of $2 trillion next year. And now I think the forecasts are going to get corrected to probably 1.6, 1.7, which is going to be a pretty massive sort of reduction. And as a result, we're going to be back focusing on technology, efficiency, investments, more M&A. There's just not companies. There's just too many companies that are running out of cash, to compete in this environment. But I think that's good for tech innovation.
So I think that's a hot take, and I like it. I think we have to clarify, though, because when you said it, the first thing that popped into my mind was that it's probably good for tech innovation not currently in the industry. And I think it's bad for tech that is currently in the industry. And what I mean by that is it is going to get so dicey, and I think it's going to get tight enough that the existing incumbents and existing lenders can't deal with it. And it is going to be good for insurgents from the outside coming in because they don't have the legacy problems. They don't have the legacy cash crunch. They haven't had profitability crushed in 2024. So it's actually good for tech innovation broadly, but it is not good for like incumbent vendors and incumbent IMBs.
It'll also probably keep, the VC market has been pretty hard on all things, I guess fintech in general, but extremely hard on prop tech and mortgage tech. It probably drags that out a little bit longer, which is probably beneficial to the ones already in the space. That there won't be a whole new crop of competition. So yeah, there's like all different layers of it. For the enterprise ones that we're relying on relief coming soon to stay afloat, like it could be a huge problem. Maybe the middle of the curve. Maybe it'll help them grow their market share. But what I always worry about is that there won't be as many new startups entering. And I've talked on the show many times about how I am a scout investor for a venture capital firm, and the amount of deal flow has just fallen off a cliff for the past year or so, hardly looking at anything. So it's, and maybe that's my fault of not sourcing, but like I used to get a lot more without trying, people looking to build new things in mortgage tech and real estate tech, and there's a lot less of those conversations the past year or two.
You're always so self-deprecating. It's hilarious.
Brock, I think you're spot on, man. I think I've heard no shortage of people that want to build something in the industry or have an idea, but they can't get funding, or they can't get support, or they can't give it a shot.
Yeah. No, it's interesting. There's a lot of
Can we take a quick break? There you go. The fist.
Nice. Oh, nice.
Downtown Detroit. We saw the Joe Louis fist. A little
Motor City. Love it.
Saw at least 4 or 5 Rocket Mortgage buildings in there too.
Do you want me to swing by? I could walk in.
For anyone that doesn't know the downtown Detroit campus.
I was going to say, Rocket's already taken a photo of your license plate. You've been marked, Jeremy. You're going to get pulled over any second for expired tags or something.
They're going to recruit me.
What's interesting is deal flow. The timing of investment capital is really interesting. Isn't that an interesting question? Because it just seems like you have this infusion of cash of X amount of companies. They run out of gas because the timing, the market placement and the timing of their investment was off. And then those companies fold, another set of companies come in, new bets get played, and then the timing gets a little bit better, may or may not be better. And then those companies either some percolate to the top because the timing was just right, and others sort of fold. God, it's amazing how difficult it is to actually gauge the market, because if the market's hot, you might be a little bit too you might be too late to the game, But if the market is slow to soon to ramp, you're just trying to stage that investment as best as you can,
Yeah, I think you will find. I think you always find in these cycles, people like to use like some of the .com bubble examples of the survivors or whatever. The ones that make it through at times when capital is crunched tend to do really well. So I've always thought that there's some like misalignment there where no one's making any like prop tech, mortgage tech investments right now. Probably a good time to do it because the competition's so low. So, NewZip's lucky that we have some really long-standing patient investors who have allowed us not to worry about this too much. But most companies, even at our stage, and certainly earlier than our stage, it's a tough spot.
Yeah, if you raised at that stage or earlier now, you at least have some runway through it. I would agree with that. I'm thinking, just as you were talking, Brock, I was thinking of Vesta, who's a good example of a startup with like really big goals, really ambitious dreams, and raised at the right time such that they have the runway now to just build. Don't have to be out there. Sure. Don't have to be out there raising. And I think those things can make a big difference.
Yeah. No, it's so what would you say to be in a flat to negative? Well, it won't be negative. It'll probably be flat to slightly improved from 2024. Do you think the game game plan for tech is pretty much remains the same?
Yes.
Yeah.
Which is what?
Of course. Yeah.
Let the vendor community eat itself. So in other words, you have the vendors you have. Everybody else is competing to show how they're better than each other. If I was running an IMB, I would still, if I haven't already done the evaluation of what vendors are redundant or what vendors I could do more with to save money, like blah, blah, blah. But rather than, I don't see a bunch of people signing up new vendors. I see the vendors all like competing, essentially cannibalizing each other until there's only a few left standing. That is also going to probably happen with some mortgage companies, but I think it's probably more acute in the vendor community.
Yeah, there may be some consolidation. I mean, there's a lot of vendor. I mean, yeah, like Jeremy said, same as the IMB conversations is like, if everyone's fighting over kind of the same things, maybe it is time to consolidate a little bit. There's a lot of conversations like that in the vendor community, I would say, broadly speaking, not like we're at a stage where we're talking about either buying or selling. We're kind of in the middle, but I'm just familiar that people are thinking that way because it is not the most, promising bounce back year. So I think that's one thing. The one thing we do a lot, we've been able to grow in this market is just offering like pilots and like head-to-head competition with existing vendors, just matching whatever they had before and competing head-to-head for business. That's how we've won most of our accounts, is just drawing up tests and pilots to earn it. Because why would a mortgage company look to do all the switching costs unless it's proven? So we've tried to like de-risk it. You can't do that for all products, for certainly not, but we're able to do that occasionally. And I know other vendors and other strategic partners of the mortgage landscape get creative as well to get in with the right companies, even at slow times.
So what's that? What do you think is next? I mean, you essentially have a market, an unchanged market, right? From 2024 to 2025. If anything, I would almost put a more negative slant to it, because because it's another blow to lenders who anticipated greater returns for 2025 over 2024. So I almost think that
somebody said to me, Rick, I
What?
don't mean to cut you off, but I have a point on that. Somebody said to me this week, hey, remember when there were people saying survive to 25? What are they saying now? And I didn't really have an answer for that because I'm not plugged in particularly to like what the thing might be, but you are. So are you actually hearing people address that fact, or is it just like crickets?
No, it's crickets. I mean, it's just, I think, well, it's too new, right? Because this just happened in the last couple of days.
Fair enough. That's
but I think but I would say that there's going to be a lot of soul searching coming over the next 90 days. The first quarter is always the toughest. You gotta post your audited financials to HUD, just to maintain your FHA endorsement. There's the audits for the servicers, Fannie, Freddie, Ginnie. There's going to be, it'll be interesting. I mean, this is where warehouse banks start to get nervous because people start missing their covenants and their cash on hand.
I think the warehouse banks are nervous. They actually are going to get to the point where they can't hit the snooze alarm anymore, is what you're saying, really. It's like they already are missing covenants, but everybody was like, we will only miss them till first quarter and then we'll be back, or whatever it was. I don't know that conversation as well, but that would be my guess. It's like, how long can you snooze? The wake-up call.
That's right. So I don't know. I mean, it'll be interesting to see. I think there's a lot of trepidation right now, and that's why I think those who have the cash are going to say to themselves, production's going to be flat. So if we're going to make money, we're going to have to free up that margin through just more efficiency. So that's where AI and others just sort of, whether it's outsourcing AI or just, other streamlined related solutions to kind of do what you have in front of you better and more efficiently. And then there's going to be solutions like Brock's that are kind of the pitch becomes, hey, you're going to do more business because of us, because you're going to have less attrition. So all of a sudden, a solution like NewZip or a CRM, company, or, lead companies, the cost per lead is going to go up because the value of quality leads are going to be in higher demand. So it's going to be an interesting.
Yeah, I think you're
race.
making a good. Sorry, I didn't mean to cut you off. You didn't.
No.
You made a really good prediction though for what. Oh shoot, Okay, you made a really good prediction for what I think is a real differentiator potentially. How much do you outsource to buy prepared leads better? How much do leads come in already prepared, underwritten, approved, verified, approved, qual, whatever? And how much of that do you still have to take on or make redundant? I think a lot of lead gen got really sophisticated in the last few years, but I think that you still have to do a lot of work, or lenders are still doing a lot of work because they don't trust it. So if you really had to get ruthless on prioritization and resources, we had Will on from OwnUp last time. Right. Wouldn't it be that you just outsource more and more to OwnUp and NewZip and all these companies and say, it better be ready when it gets to me if I'm paying X for it. But then you have to trust it, and you have to not redo that work when you get it in your door. Otherwise, you're out. So to me, it's like you hit the nail on the head, Rick, but you got to actually make your vendor do that, your partner, and you have to trust it. And then you have a chance, even if it costs more to come in the door.
Yeah.
Well, that's certainly like the playbook as my very biased suggestion would be. Rick, do you think that tracks with conversations that you're hearing with the top, IMB executives or mid-size IMB executives even? I know that you're in a lot of different conversations with a lot of different size lenders all the time. Is that kind of where you see it tracking, is more efficiency, what, cost, and not necessarily cost savings, but like just like true ROI calculation rather than like growth calculation, or what do you think about that?
Honestly, it's well, your head of operations is really going to focus on your the focus in the race to the bottom, if you will. The real Cold War race, the arms race of this business, is really a reduction in cost. Your cost per closed loan goes down. So if you fix or slightly decline the number of units that you have as an organization, you can still make either more money, or you could hold the line firm based on efficiencies that you've implemented. The rest of the organization is just focused on how do you squeeze as much from, how do you negotiate the best deal you can from a warehousing standpoint, from an investor, from a correspondent standpoint, and then how do you grow? I mean, it's good. It's a business that really thrives on low cost of sales, because what do you pay? It's a bunch of commission only, minimum wage draw, maybe loan officers. So that's why you get companies like Cross Country that'll hire 4,700 or so loan officers, because they're casting the widest net possible, knowing that as the ebb and the flow for what's the matter? I'm
laughing at he just waved and that was it. He didn't want to cut you off, but like
he's like too polite. I love that dude. Mr. 40 under 40, it hasn't gone to his head yet, so that's a good thing. But no, it's all about growth. I mean, it's going to be an intense competitive environment in 2025 because of how flat it's going to be. And I think it's if I'm an IT company, if I'm a tech company, I'd better show mortgage lenders how I'm going to help them grow, or how I'm going to help them just capture more margin. If I can't do either one of those, like clearly in one stupid slide, it's just going to be a waste of time.
Agreed.
So
I think that's well said.
All right, man. Well, happy Friday. You have plans next week? Are you going to be in Detroit all next week?
Yeah, stay in Detroit. My dad will come visit, and we'll do the Detroit Christmas experience. What about you?
Good. Yeah. No. Same thing. Kids, Vermont, all that jazz. So it'll be, or Massachusetts. So it'll be fun. It'll be a good time. So, well, good. Well, you're looking sharp, my friend. And we'll.
It's always good to see you, man. I'm glad we had this conversation. And if I don't talk, I'll talk to you before that. But Merry Christmas and Happy Holidays.
Yeah, Merry Christmas and Happy Hanukkah to those who are watching, and looking forward to the new year.
Right on. Talk to you soon, Rick. Bye.